Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through all the market weakness. Today, we're putting e.l.f. Beauty directly under the microscope. The company just dropped its Q3 earnings and, well, the market went absolutely wild. But you know us, we are not here for the hype. We are here to stress test the numbers and figure out if this beauty giant is truly building a financial fortress that's designed to last, or if it's just a pretty facade hiding some really serious structural problems. I'm your lead analyst, and with me is our market skeptic. Together, we're going to break this all down. Let's get to it. So the very first reaction from the street, it was pure rocket fuel. The second those numbers hit the wire, the stock just blasted off, jumping 13% in after-hours trading. Now that is a massive, massive move. It's a huge signal that the algorithms and the first wave of traders absolutely loved what they saw. But you know, a double-digit pop like that, it always demands a second look. It forces you to ask the hard question. Was this a justified re-rating based on impenetrable, solid-as-a-rock fundamentals, or was it just a short-term sugar rush that completely ignores the deeper risks? Here at Iron Financial, we don't chase percentages, we dissect them, and that is exactly where our market skeptic comes in. Thanks. So here's our blueprint, our plan of attack for today's analysis. First up, we're going to look at those headline numbers, the earnings blowout that caused that huge 13% jump. Then, our lead analyst is going to lay out the full bull case, showing you how they're forging what really does look like a growth fortress. But then I'm going to start applying some pressure. I'm going to search for any and all cracks in that foundation. That's the bear case that you absolutely have to hear. From there, we'll dive into their marketing machine, and we'll ask if it's a smart investment or just a really expensive habit. We'll dissect their blueprint for the future by analyzing that updated guidance. And finally, of course, we'll deliver the iron verdict. So let's get to work. All right, Section 1, the earnings blowout. And let me be perfectly clear here. The top-line results, they weren't just good. They were a show of absolute, unadulterated dominance. This wasn't just a simple beat. This was a statement to the entire market. In an environment where any sign of weakness gets ruthlessly punished, e.l.f. came out and just put up a wall of numbers that, at least on the surface, looks completely impenetrable. Honestly, this is the kind of report that bulls absolutely dream of. Now let's dig into what's really fascinating here on this slide. It's the sheer magnitude of the beat. I mean, just look at the earnings per share. Wall Street analysts, they were looking for 70 cents. e.l.f. delivered $1.24. Okay, that's not a beat. That is a complete and utter demolition. They didn't just clear the bar, they launched it into orbit. We're talking more than 75% above the consensus estimate. Then you pivot to revenue. The street wanted around $456 million. The company comes in and posts nearly $490 million. Look, these aren't rounding errors. This is a fundamental massive outperformance that tells you this business has incredible momentum. And it's these numbers, right here, that set the entire stage for the bull case. And that brings us right to the bull case. Because you don't post numbers like that by accident. This is not a fluke. This is not a one-off good quarter. What we are witnessing here is the result of a deliberate, long-term strategy to build a true financial fortress in the cutthroat cosmetic space. The company is methodically laying brick after brick, and that wall, it's just getting higher and stronger with every single report. So let's break down the core pillars that make up this fortress. Okay, the first pillar, the very foundation of this entire structure, is growth. A staggering 38% increase in net sales year over year. I want you to let that sink in for a second. In this economy, with all the concerns flying around about consumer spending, e.l.f. is growing at a rate that most companies would absolutely kill for. Remember, this isn't some new tech startup in a brand new category. This is a beauty company operating in a very mature market, and it's expanding its top line by almost 40%. This growth is firing on all cylinders, across their retail channels, their e-commerce business, both here in the US and internationally. It is an absolute powerhouse of a number. Now, here's the crucial point. This isn't just a one-time event. This number, 28, it represents the very bedrock of the entire bull argument, consistency. This marks the 28th consecutive quarter of net sales growth. That's 7 straight years of positive, uninterrupted expansion. Think about everything that's happened in the last 7 years. We've been through wild market cycles, a global pandemic, huge shifts in consumer trends, and through it all, the e.l.f. growth engine has not stalled, not once. That shows a deep structural connection with their customer base and an incredible ability to execute quarter after quarter after quarter. This isn't just momentum, you see. It's a proven, durable growth algorithm at work. And this chart? Well, this just brilliantly illustrates the acceleration of that growth. Just look at the comparison here. In the very same quarter last year, they pulled in about $355 million in revenue. This year, it's almost $490 million. That's an increase of more than $134 million in revenue in a single year for just one quarter. The bars you're looking at don't just show growth. They show a company that is hitting an entirely new gear. It's not just getting bigger, it's getting bigger faster. This right here is what exponential growth looks like on a financial statement, and it's the absolute core of the bull thesis. And hey, you don't have to take my word for it. The CEO, Tarang Amin, he said it himself. He explicitly calls out the consistent category-leading growth we've delivered over the past 28 quarters. He's highlighting their value proposition, their innovation, and what he calls their disruptive marketing engine. What he's doing is signaling to the market that the company's leadership doesn't see this as a peak. They see it as a continuation of a long-running trend. They are telling everyone that the fortress is secure and the strategy is working exactly as they planned. But of course, a fortress is only as strong as its weakest point. And I think it's about time for our market skeptic to start testing those walls. All right, I'll admit, that is a very, very compelling story. A fortress of growth, 28 quarters of success. I mean, it sounds absolutely indestructible. But here at Iron Financial, our job is to take a sledgehammer to these beautiful stories and see if they actually hold up under pressure. So now, we begin the siege. It's time to go looking for the cracks in this foundation, because it doesn't matter how strong a wall looks from the outside. A few critical weaknesses can bring the entire thing tumbling down. And that really is the central question we have to ask ourselves, isn't it? Is this impressive fortress built on solid ground, or is it maybe sitting on a sinkhole? Because this kind of explosive growth, it often comes at a steep price. You see, companies can borrow heavily, spend aggressively, and basically buy revenue, making that top line look absolutely fantastic while the balance sheet just starts to rot from the inside out. We need to look underneath these beautiful sales numbers and inspect the plumbing, the wiring, and the foundation itself. And boom, here it is, the first major crack we found when we started digging. Look at this balance sheet comparison. You have to see this. Just 1 year ago, at the end of December 2024, e.l.f. was sitting on about $154 million in long-term debt. Okay, pretty manageable. Now, fast forward just 1 year. That number has exploded to nearly $817 million. Let me say that again, $817 million. That is more than a 5-fold increase. They have fundamentally changed their capital structure, taking on a truly massive amount of leverage. I mean, this is the textbook definition of pouring gasoline on a fire. Yes, it fuels growth, but my God, it also introduces a whole new level of financial risk if anything at all goes wrong. And it really begs the question, where did nearly $750 million just go? We'll get to that answer very shortly. Okay, before we jump to the next point, let's quickly define a really critical term: gross margin. So what is it? It's simply the percentage of money a company keeps from each and every sale after paying for the direct costs of actually making the product. Think of it as a pure measure of profitability. A high and, importantly, a stable gross margin is the hallmark of a strong, durable business that has real pricing power. A declining gross margin, on the other hand, is a serious warning sign. So with these record-breaking sales, you'd probably expect their profitability per item to be rock solid, right? Well, you'd be wrong. Their gross margin actually decreased by 30 basis points, down to 71%. And the company tells us directly this was because of higher tariff costs. Now, this is a critical detail. It means that even with their incredible sales volume, external pressures are actively squeezing their profitability on every single product they sell. The fortress wall might be expanding outward, but the bricks themselves are becoming just a little less profitable. It's a subtle erosion, but it is an erosion nonetheless. And here is another point of real concern, and it's one you are not going to find in the company's glossy press release. While all the headlines are celebrating this massive earnings beat, what has the professional analyst community been doing behind the scenes? Well, in the last 90 days, there have been 15, count them, 15 negative earnings per share revisions for e.l.f. Beauty. 15 negative revisions and 0 positive ones. Now, for those who don't follow the jargon, an EPS revision is when a professional analyst changes their forecast for a company's future profits. A negative revision means they are lowering their expectations. So what this tells us is that before this report came out, the very experts whose job it is to model this company's performance were getting more and more pessimistic. Now, this blowout quarter flew in the face of that trend, which begs the question, is this quarter just an anomaly, or were 15 different analysts all wrong? It introduces a real layer of uncertainty about the true sustainable earnings power of this business. Okay, so let's address one of the key drivers here, all that spending. The bear case correctly points to soaring costs, but from a bull perspective, you have to spend money to make money. It's that simple. e.l.f. isn't just throwing cash away. They are making a calculated, strategic investment in what they call brand heat. So this isn't just an expense line item to be slashed, it's the very fuel for the entire growth engine. Let's see how this all connects. Let's break down the flow here so it makes sense. First, you start with the raw number. Selling, general, and administrative expenses, we call it SG&A, jumped by nearly $62 million in a single quarter. That is a huge increase. Now, the company is very clear that the primary driver for this was a massive ramp-up in marketing and merchandising. This is that disruptive marketing engine the CEO was talking about. They are consciously choosing to reinvest their profits right back into grabbing consumer attention and taking up more shelf space, which directly leads to them gaining market share from their competitors. They see it as a virtuous cycle: spend more, get more attention, sell more product, and then do it all over again. It looks perfect on paper, but I know our skeptic sees a potential flaw in that logic. He's right. I absolutely do. Because that forces us to ask the most important question for this entire business model. Is this level of spending actually sustainable? Or are they just renting customers for a quarter? Look, it's one thing to spend your way to growth when the market is hot and capital is cheap. It's another thing entirely to try and maintain that pace when you're also taking on mountains of debt and facing real margin pressure. How much of that incredible 38% sales growth was actually organic, and how much of it was just purchased with a $62 million marketing check? If they ever have to pull back on that spending, does the whole growth engine just grind to a halt? This, right here, is the central debate around this stock. Well, the best way to try and settle that debate is to look at what the company itself is forecasting. Forget what happened last quarter for a second. What does management expect to happen next? And that brings us to their blueprint for the future, their updated guidance for the full fiscal year. From the Bulls' perspective, this is the final, decisive piece of evidence that their strategy isn't just working, it is accelerating. This is their ultimate statement of confidence. Let's just break this table down, because it is incredibly powerful. Just look at the revenue line. Their previous outlook for the full year was already very strong, topping out at $1.57 billion, and you can see the analyst consensus was right there with them. But now, they've raised that forecast to over $1.6 billion. They are telling the market they expect to bring in an extra $40 million or so above what even the most optimistic projections were calling for. Now look at EPS. They've raised their guidance from a high of $2.85 to a new high of $3.10. That is a massive jump, and it completely blows past the analyst consensus of $2.87. Management isn't just saying things are good, they are putting hard numbers on the table that suggest this momentum is carrying forward with incredible force. So that brings us to the end of the line. It's time to weigh all the evidence, the absolutely incredible growth against the massive new debt, the blowout earnings against the very real margin pressure. It's time to put it all together and deliver the iron verdict. After stress testing this company from top to bottom, is e.l.f. Beauty a generational growth opportunity, or is it a carefully constructed trap for unsuspecting investors? Let's lay out the final arguments side by side. So on one hand, you have the bull case, the fortress, and it's built on irrefutable strength. That massive 38% sales growth, an incredible track record of 28 straight quarters of expansion, a dominant earnings beat that completely shocked Wall Street, and of course, raised future guidance that signals absolute confidence. But then, on the other hand, you have the bear case, the cracks, and it's built on equally valid concerns: a five-fold explosion in long-term debt, shrinking profitability at the gross margin level, soaring marketing costs that might just be buying that growth, and that backdrop of negative analyst sentiment leading up to this report. This is the essential conflict you have to resolve for yourself. So here it is, the iron verdict. The growth is not an illusion. It is absolutely real. You cannot fake 38% revenue growth or 28 consecutive quarters of it. e.l.f. is a high-octane growth engine. But, and this is the critical takeaway, that engine is being fueled by a high-risk mixture of debt and aggressive spending. They are pulling forward future growth by leveraging up the balance sheet and pouring money into marketing. The fortress is real, but its entire construction is being financed with a very large and a very risky loan. And that leaves us with the final, provocative question that you have to answer for your own portfolio. Growth is never free. It is always expensive. Is e.l.f. Beauty paying a price that its foundation can't ultimately support? They have built something truly impressive, no doubt about it, but they've done it by taking on a significant amount of risk. The reward is obvious from the stock chart, but you, the investor, must decide if that reward is worth the risk of those cracks in the foundation finally giving way. Thanks for joining us at Iron Financial, where we forge stronger portfolios. We'll see you next time.